Hi, morning all. Welcome back to Mankapay 8 here. Right. So, looking at the S&P 500, well, it advanced around 0.72% on Monday session to close at 7537.42 points, breaking its the recent consolidative patch as the aggressive deep buyers rush back into those tech shares. So I think the index was heavily anchored by a powerful, 4.2% surge in the semiconductor index, driven by an extended chip supply partnership between the Broadcom and also Apple, alongside the participation over a massive new AI link listing and also the corporate earnings. Right. So looking at our US trading stocks that we published recently, overnight yesterday, right? So we got Coca-Cola, stock got KO. So the stock experienced a breakout at $83 level. Expect stock travel towards the $87 level on a strong momentum, followed by the next resistance at $91 level. So now if the counter to reverse, do watch out for the 79 level for the immediate support, as it could indicate an initial trend reversal signal. And also next we have RTX Corporation, stock code RTX. So we are looking at the charts now, right? The counter charted a high market structure, forming a high low market pattern, right? And breach above the $195. So if the stock to climb up higher, we could see that it might travel towards the 208 level. Second resistance is at $220 level. Well, now the stock to slide lower below this $185 level, this might shift the very structure. So today we have, for US trading stocks, we have two breakout stocks, which is KO and also RTX, right? So looking at the China A50 futures, well, it edged higher by 0.43% on Monday's session, successfully defending its immediate support floor at the 14,700. So the index found its stability as the mainland market witnessed a healthy rotation of the institutional liquidity away from the overextended tech counters into the defensive banking, energy, and also some of the agriculture heavyweight, further bolstered by new I would say regulatory trading and also the refinancing support measure introduced by the CSRC. Well, if the rebound to follow through, may propel higher to test the 15,500, and also it may cross above the 200-day SMA lines. Well, looking at the WTI crude oil futures, well, it traded largely sideways during Monday session, drifting slightly lower by 0.25% to consolidate around 68 cent per barrel, right? While the trading volume remain relatively muted following the extended US holiday weekend. I think the energy was kept firmly under pressure by the supply side bearish catalysts driven by the newly ratified OPEC plus production increase and also the ongoing normalization of the commercial maritime shipping through the Strait of Hormuz. So yeah, we are still looking at the downside movement for now, and if the ultimate manage to break below the consolidation range, at this juncture, we are looking at the $60 level. So this is also supported by the SMA lines, and if you monitor closely, you can see that the 21-day SMA line is now pointing towards the 200-day SMA lines. Right, so looking into our local Malaysia market, the KLC extended its winning streak for the third consecutive session on Monday, gaining around 0.27% to close at 1683.53 largely propelled by the selective institutional accumulation, in the major banking and also the plantation heavyweight. Well, in contrast, if you see FKLI, or the FKLI futures decoupled significantly from the KLCI, drive sorry dropped down by 1.5 points, or 0.09% as the aggressive arbitrager and also the institutional player heavily priced in the wide discount over cautious broader market breadth and also the upcoming domestic policy risk. And also, if you look at the sector heat map, the cross sector stock heat map has breakdown, uh, sharp divergence seen during the money session, while the targeted, Maybank 1.3% gain in Maybank, and also 10.08% surge in UMS provide massive index link lift to the KLCI by 0.27%. I think the broader market reveals deep institutional liquidation across the electronic tech, manufacturing, and also utility, validating the steep 1.5 point discount price into the FKLI futures. I think the entire electronic tech manufacturing blocks were hit hard, and if you see here names like Frontcan, Netgate, UMS, as well as the Skychip, shed between 2 to 4%. So this tech-led liquidation bled directly into the major industrial, um, and also the utility anchor, with the press metal drop nearly 2%, while the YTL Power, um, YTL Corporation slid over uh, 1% each, right? So yeah, talking about the sector performance, right? From yesterday's move, we can now see that most of the sectors are rebounding slightly from last week. However, some of the sector resorted sideways and consolidated on Monday session, or yesterday's session. So we can see here top gainers were coming from the transportation sectors. Looking at our Malaysia trading stocks. So today we have Petronas Dagangan. So the stock is on its breakout formation high at 19.30 cent, 19 ringgit 30 cent level on strong volume. We expect that the momentum to keep bullish and the stock able to propel higher to test the next resistance at 20 ringgit 50 cent, followed by 20 ringgit 30 cent level. So if the stock to clear below this 18 ringgit 50 cent support, this could reverse the course and run lower. Next, we have Sunway REIT, right? So the stock is experiencing a breakout as well at 2 ringgit 20 cent levels. If the stock to remain bullish, we expect the stock to extend higher towards the 2 ringgit 35 cent level. And in the coming session, second resistance is at 2 ringgit 45 cent level. And also do keep an eye at the 2 ringgit 10 cent support for any attempt of reversal. So again, for Malaysia also, we have two breakout stocks, which is Petronas Dagangan and also Sunway REIT, right? And lastly, for the FCPO, well, the future contract halted its uh, two session slide on Monday, jumping around 1.56% to climb back above the 4,500 ringgit level. Right, so the technical rebound was triggered by the aggressive short covering following the weak Malaysia ringgit and also the robust gains in the rival global veg oil market, though the upside remains heavily capped by the macro supply pressure. However, for now, the 50-day SMA lines are blocking the upside movement and may slid lower in the coming session, moving towards the 43 90 ringgit. So looking at the 200-day moving average line here, it is now trending sideways, showing that the bullish may subsided. Um, However, once again, do watch out for the 4,600 level if the bullish strength to follow through. Uh, Again, bear in mind that in a bearish setup, resistance tend to be firm, and the price may reject the this level lah, right, at 4,600 level, and our stop loss remains firm, remains back at 4,700 level. Right, so I'll stop here and pass you to the next presenter, Queenie. Thanks, everyone, and happy trading.
Okay, thank you, Aiman, for the presentation. So now I'll just share my screen first. Hold on, yeah. So today we have issued an IPO new report on a company called Stratus Global. Okay, for introduction, Stratus Global is a Penang-based factory automation solutions provider specializing in clean room automated material handling system. We call it AMHS, solutions for the global semiconductor industry. So for its solutions, there's three types. First one being conveyor-based AMHS, and then second being hybrid AMHS. For hybrid, there is a combination of conveyor-based as well as overhead hoist transport, and then also a bit of SRS inside it. So it's like combination of everything. That's why we call it hybrid. And then thirdly, they have this SRS, which is automated storage and retrieval systems designed to store and retrieve critical materials. Okay. So about 66% of revenue come from hybrid MHS in FY26, and then 32% of FY26 revenue come from conveyor-based MHS. About 3% of FY26 revenue come from SRS. Okay. So the company have a moat from deep engineering know-how. It was established since 1998 with a track record of 28 years. So the group has built proprietary conveyor-based AMHS, hybrid AMHS, and SR solutions, complemented by its in-house tool control system software, TCS. Okay. So for the global semiconductor industry, its solutions are certified to ISO 9001, 14001, and 45001, and are deployed at MNC front end to handle both 200mm and 300mm wafer and back-end semiconductor customers across Asia, Europe, and North America. So Stratus designs, fabricates, assembles, and tests almost entirely in-house, unlike peers that outsource. So this is a key differentiator underpinning its higher margin, while stringent requirements of handling wafers sets high barriers to entry for its industry. So as for its margin against its peers, you can refer to this table, to this figure here. So my figure 5, you can see its peers Daifuku, Murata Group, Miller Automation, Panda Master has a portion of their business in this, okay? And then FS is an automation, and all its peers are PAT margin is at the 12% averagely. Whereas for Stratus Global, its profit margin is at 26%, the latest one, okay? Okay, so let me just go to this industry growth first. So we all know that now that it's a structural semiconductor up cycle, so that will support the demand for its systems. So for example, Semi expects sustained capex into 300mm wafer fabrication capacity through 2030, taking a rising share of global installed wafer capacity. Because 300mm wafer is mainly used in AI chips, okay? Then WSTS also forecasts the broader semiconductor industry to grow 90% in this year on AI or data center driven E&E demand. Okay, and then Q1 research projecting the global semicon AMHS industry to grow at the 5.4% CAGR through 2031 to USD 4.5 billion market. So the company already embedded in 300mm wafer facilities ahead of several peers. So the group is well placed to ride this upcycle, aided by Malaysia's national semiconductor strategy and 13 Malaysia plan. Okay. So from our net profit forecast, you can see that we have earnings 3 years earnings CAGR of 24% from FY26 to FY29. Okay. So we use PEG of 1 times, which translate to a PE of 24 times. Okay, to derive our fair value of RM1.55. Okay, so the PE of 24 times is also in line with the KLTech 5-year average PE. Okay, as you can see from this figure 4. Okay, so key risks to our earnings forecast would be loss of key customers, slowdown in semiconductor capex, delay in project, and FX fluctuations, especially USD MYR. Okay, as a large chunk of its sales are derived in USD. Okay, so all in all, Stratus Global plans to raise 285 million from this IPO, mainly to fund its facility expansion, overseas offices, and R&D. So backed by a 28-year track record in clean room automated material handling systems solutions for the global semiconductor industry, strong margins, and a structural upcycle in semicon capex, we expect resilient earnings growth. So at just 12 times FY28 FPE, okay, against the KLTech 5-year average and 24% 3-year earnings CAGR, its valuation appears compelling. So with its fair value of RM1.55, this translates to a potential return of 94% from its IPO price of 80 cents. Closing application date will be 10th of July 2026, and indicative listing date will be 21st of July 2026. Post-listings, the company will have implied market cap of 1 billion. And it will be listing on the main market with Bursa code of 5356. Okay. So for information, there's also no offer for sale for this IPO. Okay. Okay, so that's all from me. Okay, before I pass on to the next speaker, I would like to remind everyone that tomorrow there is also a webinar on Stratus Global at 1 p.m. So please remember to dial in to understand more about this company. Okay, so thank you, and I'll pass on to Jeffrey.
Hey, thanks, Queenie. I've got an update note on CelcomDigi following a recent meeting with management. Maintaining our buy call. DCF derived target price lowered slightly from 360 to 350. That's also because of some adjustments to earnings, which I will explain a little bit more. As you know, the stock is going through a transformation. CelcomDigi was merged in towards the end of 2022, so they're into their 3rd year of the integration process. It's almost completed. It's probably about 95% done. What's pending really is the transformation of the IT platforms, and they're going through the business support system integration, which is a key component of the overall IT transformation exercise. I would say that this is basically the largest, IT overhaul that the two telcos are going through now. There are a bit of concerns here. Obviously, with an integration of this magnitude, there could potentially be some downtime in terms of network. Subscribers may not be able to provision for certain services, and there may be billing issues. So we will need to actually monitor the developments closely in terms of the integration. Now, if you look at the synergies that they've talked about, I think management has guided for about pre-tax synergies of about 600 to 800 million by 28. You see a lot of these cost synergies coming through from the second half of this year. Really, it's at the tail end in terms of the integration. So there'll be a lot of OPEX savings in terms of the network side of things. They have basically consolidated their network, 24,000 sites pre-merger to about 16,000 odd now. So going to 27, you see significantly more savings in terms of rental leases, network rentals, procurements. A lot of decommissioning costs, will fade away. You start whipping in the savings in terms of having a combined network altogether. They've said that the cost impact from geopolitics, particularly the energy crisis and all that, it's been fairly manageable. There is some impact, but nothing significant. So they are maintaining their 26 EBIT guidance of low single-digit growth. This is pretty much on par with the service revenue guidance of low single-digit as well, which basically implies that EBIT margin will be flat going to FY26. FY27, you'll see a lot more synergies coming through. So that's the reason why we've actually projected a much bigger jump in terms of earnings growth, 18.4% to be exact, going to FY27. They've disclosed their OPEX savings target for this year. The number is 465 million. 45 million of it has been booked or realized in the first quarter of this year. I just want to point out that as they move or progressively migrate their traffic from 4G to 5G, there will be savings as well in terms of network cost. Okay, on the equity accounting of DNB, probably will take place this quarter, sometime in this quarter. DNB, of course, is still loss-making. A lot of support needed financially from the stakeholders. CelcomDigi has the 33% stake in DNB. Same stake held by Maxis as well as YTL, the other two shareholders. They've made a significant loss of 1.2 billion in FY24. Losses are being managed and it's coming off. So we have projected significantly lower losses for FY26 and 27. For 26, we are projecting a loss of about 600 million for DNB. That goes down to about 500 million from FY27. So forecast-wise, we've built in the losses from DNB, also assuming significantly higher wholesale costs in terms of 5G. As this year, I think telcos will revert to the minimum payout. Not forgetting that there will be some offsets from the cost synergies that are coming through. So key risk to the stock really is competition, weaker expected earnings and delays in the BSS platform upgrade. That transformation is expected to complete by the first quarter of 27. So with that upgrade in billing platform, you should see them coming out more aggressively commercially in terms of type of packages, new price plans and all. Currently, they are still fairly hampered by the fact that the ongoing process of upgrading two different bidding platforms currently. So in the short to medium term, integration costs will still be there, but I think come the fourth quarter of this year, you see that gradually fade away. So this is our top exposure in terms of a mobile pick. We're maintaining our buy call, new DCF derived target price of 350. Okay, I'll stop here for now. I think that wraps up our morning cuppa for today. I'll see you again tomorrow, bright and sunny. Thank you.